Welcome to Bloomberg Markets. I'm Sonali Basak. Let's get a check on these markets because the S&P 500 has been looking really hard to break 3 days of losses, and you are essentially now flat on the day. We actually had turned negative for a while, but let's see where things end up. Of course, you have some specific trades like Tesla helping the market float a little higher. You are still seeing the NASDAQ 100 off of session highs, but still about 0.5% higher. Interesting in the bond market as well. You had a pretty significant sell-off this week. You had the 10-year yield flirting with 4.25 once again. We are back now down to 4.20, about a 4 basis point move lower. We'll keep an eye on that throughout the week as well. Interesting jobless claims this morning came in lower than expected, but still the bond market looks to find some stability here. New York crude, we just got under $70, back at $70 now, but it is still 1% lower on the day. We're going to now bring you some midday movers too on the equity side. Bloomberg's Abigail Doolittle is here for that.
Well, let's start off with the shares of Tesla. They're sharply higher on the day, really surging this after they put up a very, very strong third quarter, beating adjusted earnings estimates by 21% to put up 72 cents per share. Sales basically flat, but it's the outlook. CEO Elon Musk talking about growth that could be somewhere between 20 to 30% after a year or two of very flat growth. Investors sending these shares have to the best day going all the way back to March of 2021. UPS also having a very nice day. They put up an 8% beat on adjusted earnings, and it represents the first time that they've shown growth in about 2 years. So investors really cheering the idea that maybe the turnaround is finally happening here. They did see a 6.5% increase in daily U.S. volume, so another positive. Some analysts on the street are calling this a relief rally, clearly higher, up about 5%. And then finally, Boeing, not so much. One stock trading to the downside, or at least one stock, down 2.2%. The union did not approve the deal for the 35% pay increase over 4 years. They want that defined benefit pension plan. In this day and age, it's a very limited area of workplaces that offer that defined benefit each time. So this negotiation period could go on for some time, Sonali. Absolutely
fascinating matter of pensions, and investors really underestimating the power of labor. That is Bloomberg's Abigail Doolittle. We're going to talk more about these broader markets now with Callie Cox. She's the chief market strategist at Ritholtz Wealth Management. Love talking to you. You always have a sober view of these markets when everyone else seems to be freaking out about one thing or another. You know, one thing everyone is looking forward to here is the election cycle. The election cycle is making these earnings trades very complicated to really read out of. It seems like a lot of investors are really holding back and waiting for that uncertainty to really clear the air. What are you seeing?
Sonali, I think that's the right read. I mean, the election, of course, is less than 2 weeks away. And there's a lot of, I mean, this is underestimating it, but there's a lot of noise out there on what could happen. So I do think investors are sitting on their hands a little bit. We've certainly heard that on our side. Lots of questions about the election, lots of questions about what it can mean for the economy and portfolios. I do think we're seeing this common thread, though, coming out of the economy and coming out of earnings. Expectations were way too low. They got way too low in July and August when a couple of disappointing jobs reports pushed everybody to think that we were on the edge of recession. And now the market is simply reflecting that that was a little off base, even though the data looks okay. It doesn't look spectacular.
Well, to that end also, you have to wonder where you have kind of just okay data, but you have pretty high valuations. And is this kind of pause you're seeing from investors more about the uncertainty, or is it more about the fact that we are just riding near record highs still?
Well, we're definitely at record highs. And I think that there's this urge to say, okay, prices have never been this high, so why would I invest now? But I'd say two things to that, Sonali. First of all, I mean, we've seen time and time again throughout history that it pays to buy at record highs. And if you believe that the economy is in an okay state and that interest rates and the macroeconomic environment support risk assets, then you probably should invest, even though prices are high. The other thing is valuations aren't high across the market. I mean, if you look toward big tech, if you look toward NVIDIA, for example, you could probably make an argument that valuations are high. But outside of tech, especially in rate-sensitive sectors, consumer staples and real estate come to mind. They actually look quite attractive. I mean, small and mid caps look attractive here as well, especially in a rate-cutting environment.
I'm glad you brought up the consumer. That's something I've been asking about a lot lately. And you brought up staples in particular, but it's actually the discretionary trade that since you saw that first rate cut, you definitely saw a significant bid into those stocks, but it's been a choppy trade. How risky is it to get into the discretionary sector at this point?
So consumer discretionary is tricky, and I want to caveat this with I hope the economy stays afloat and the Fed is able to apply the right touch to everything so that more cyclical sectors can perform better. But consumer discretionary is tricky. I mean, for one, it includes Amazon and Tesla, which are consumer discretionary stocks, but they're not exactly the kind of retailers that one thinks about when they consider this being more of a retailer focused sector. The other thing is consumer discretionary relies on a consumer that has a flexible budget that isn't, constrained in any way. And, the job market isn't in a great place right now. It's looking okay, but companies aren't aggressively hiring and people out in the job market are having more trouble finding jobs. So I think you have to be a little bit more defensive in that area. And if you're looking for rate sensitivity, I think you find it from consumer staples and their dividends.
Callie, you're looking at an S&P 500 that even after you saw a 3-day decline and choppiness today, it's still over 20% higher on the year. In fact, the back-to-back gains from last year to this year, you haven't seen back-to-back gains of north of 20% since the 1990s. Why not sell and take your profits at this point and step back for a minute? Why not wait till prices correct a little more?
We think we're at a moment where maybe some rebalancing is prudent. If you're over invested in tech stocks, it might be a time to take a step back and understand what the right allocation might be in your portfolio for tech versus everything else. But I don't think you can step completely out of this market. And it's because expectations have been consistently low. I mean, that's why we've seen 2 pretty incredible years in the stock market, Sonali. This bull has ridden on doubt and skepticism. And just a year ago, everybody thought we were, heading into a recession, and that still hasn't proven true. So I think in the absence of evidence of a recession, you have to believe in this bull market.
Okay, so you have the S&P 500 up more than 20%. The S&P equal weight is still only up 13% on the year. To the extent you look to indices to really reflect some of the market's broadening here, where would you go?
Well, I mentioned small and mid caps. I think when you look at small caps, I typically look at the Russell 2000 for historical measures, but the S&P Small Cap 600 looks a little bit more interesting because it has that quality screen on it. There's that profitability screen that only includes companies that are making money. So look at small and mid caps. I know the S&P has a mid cap index as well, but I mean, from a very basic level, I think people forget that, the US economy isn't just the 500 largest companies that we hear about every day. And, the small businesses and small companies have been hit really hard by higher interest rates. But now that the Fed is providing some relief there, I mean, we could see a bounce back trade.
Callie, we thank you so much for your time. Like I said, sober views in a crazy market. And of course, that small cap, mid cap trade is one a lot of investors are certainly rooting for. Now, coming up, a check on commercial real estate, especially when it comes to private credit. We're going to speak with Madison Realty Capital on that front. Very interesting story on the heels of rates that have stayed quite sticky. Stick with us. This is Bloomberg. This is Bloomberg Markets. I'm Sonali Basak. I want to take a look at a stock now that has gone public. We're looking at Ingram Micro. It went public at $22 a share, but opened much higher at $25.28. Priced to perfection, really. And you're looking at a pop now of more than 16.3%. Interesting. This was a private equity-backed company. It is testing the waters for what a broader set of companies could look like in public markets. We will talk to the CEO later on this hour. Now we're going to switch gears. We're going to talk about the property market. It's stirring again, bolstered in part by the Federal Reserve's first interest rate cut in more than 4 years. Last week, Amy Price, president of real estate investment firm BGO, spoke about what feels like an inflection point in commercial real estate.
We will look back and see the latter half of 24 as that turning point for commercial real estate broadly. Now, as you pointed out, office is a bit of an exception to that. And I think we started to see that even in anticipation of that first rate cut. We saw more liquidity in the market. We saw more activity both on the credit side and on the equity side.
And here in studio for more is Josh Zegen, managing principal and co-founder of Madison Realty Capital, which has around $20 billion in assets under management, mainly connected to commercial real estate private credit. Also with us, Bloomberg's Abigail Doolittle, who covered this very closely for us, has been all over this space. We start often with rates. I think with you, the place to start is commercial real estate, because there's a sense in the market, you talk to Blackstone, you talk to many others, that we're at that bottoming of the market. How much more pain, though, is there before we can say we have hit rock bottom?
So it started to feel like we were at the bottom and there was the turn of a new cycle. But, you know, the backup in the Treasury right now in the last week has put a pause, I think, on institutional real estate investors and investors as a whole. It's very hard for investors to make a market between a 3.5 and a 4.5 Treasury. They really need more of a tight band within some sort of a 4 to 6 month consistency to start committing to new deals. And that's a real challenge for the sector in general, because one of the problems right now is money is not going back to investors. Transactions aren't happening. So the fact that this has now put a pause in the market or sort of a reluctance to commit to new deals is a challenge.
That's really pretty incredible what you're saying, that just over the last week, this backup in rates that we've seen, about 50 basis points for the 2-year yield, 60 basis points for the 10-year yield, could basically bring a massive asset class, commercial real estate, to a halt. What does that look like in reality? Like, it just literally grinds to a halt?
I don't think it's a grinding halt, but I think there's a number of investors that started to commit to new deals in the first 6 months of the year with a perception that rates would be coming down. There's still a perception rates will be coming down, but the question is at what pace and how much.
So folks back off a little bit?
A little bit. I think there's a lot of uncertainty in the market, and some are saying, why commit now? Am I being rewarded for being early in this cycle? So.
Well, what if rates go higher? I mean, there's some people out there calling for 5% on the 10-year, and you're looking at a yield curve that has not been able to stick the landing here when it comes to the steepener trade. So what does that mean in terms of the uncertainty, even about the first 6 months of next year?
Well, again, therein lies the problem, because right now that uncertainty of such a wide band is causing the challenges. And you have this office sector right now that's obviously tying up a lot of capital in the system. So you can sort of make a market in multifamily and other more liquid asset classes, but the challenge is you have such a structural change in where investors are investing. And given that office made up 15 to 30% of investors and banks' credit, that's a real challenge. Money is not going back as freely as you would have thought.
Let's talk more about office, because my understanding of what you're saying is that office is not just in a closet somewhere while the rest of commercial real estate is rebounding, but office is more like a weight around the leg of commercial real estate, and it's tying up capital that some of the big sovereign funds, I know you were just in the Middle East, that they can reinvest. So is it a bigger problem than what some of the other folks in commercial real estate are saying? Could it really drag along this bottom, make it longer than what some are expecting?
Well, I think, again, that sector is going to drag capital from coming back to investors. So naturally, to get capital for new deals, you need capital back from investors, and that's really the challenge.
So Rich Hill of Cowan & Steers, he spoke to us the other day, and he's actually saying that he thinks that if he had to guess, that office is the thing that you really want to be buying right now, that a ton of people are going to make money. You know, at some point, he's going to be correct. If you had to guess based on everything you're saying, because you're so close to the money in the banks, when would you think is the right time to buy office, especially these buildings out on, say, 3rd Avenue that some are saying are 10, 20 cents on the dollar? Well,
they're not being bought for office. They're being bought for other. They're being bought for knockdowns. They're being bought for residential development and other. So I think that I wouldn't say that, you know, I'm a big bullish believer in office. I think you have Class A and then you have everything else. And Class A will survive, albeit at a higher cap rate than maybe 2 years ago. But I think, again, it's going to sort of clog the system from a reallocation of capital, and that'll hold the market back from an investment sales standpoint.
I'm glad you brought up kind of the plumbing of the system as it pertains to the institutional investors. What about the banks, right? We have gotten through the largest of banks. We have seen limited pain when it comes to commercial real estate, but it's really those regionals. How much are they really able to commit new capital to the real estate industry after the pains we've already seen?
So the challenge in the banking sector is you have the very big, and then you have everyone else. And everyone else plus makes up 5,000 or so banks. So they're really tied up with capital in long-term fixed-rate loans and the fact that they have a liquidity mismatch. And that's a really challenge with the actual model of banking. I think we're taking a huge part of what happens going forward in the private credit business. And Madison, we have multiple products, some of which we're providing direct loans to borrowers, and others of which we're back leveraging other private credit funds. And if private credit is going to survive to take a lot of what the banks formerly provided, they need leverage to produce the returns that investors want. And we're spending a lot of time providing A-notes, loan-on-loan financing, and credit lines to other private credit industry participants.
Yeah, the growth of private credit over the last couple of years, it seems as though everybody, even folks that weren't in private credit before, just because everything has been so ground to a halt, are getting into it. But, I want to ask you about regulation. It is, of course, an election year. Some are saying that regulation has been halted because of this, but regulation could come back next year. Relative to these regional banks, do you think that we're going to see some of them blow up, or do you think that there's going to be consolidation if the regulation does get tougher?
I think there will be more consolidation in the banking sector in general. There's just too many banks out there, many of which are so lopsided by very, very low fixed rate loans, and then this liquidity mismatch of having to attract deposits at much higher rates. So that's really bogging down the system, and I think there will be a lot more consolidation in the system.
So what is the demand picture? We're sort of alluding to it, but what is the demand picture for the credit that the banks won't give, the mezzanine and the other type of construction loans and that sort of thing? Is it strong? Is it robust? Do people want to build if they can get the money?
So right now, it's more on pause, which is healthy for the system because there's still the one positive or major positive about the real estate sector right now in many asset classes is very, very supply constrained. And I think you will see again, a lot of the deals you're seeing today are completing old deals, and there's need for recapitalizing those deals. So a lot of the deals that we have opportunities with are providing money to finish a building that needs a recapitalization. There are some new starts. There's some markets where, for example, in New York, there's a 421A, which was a tax abatement that had an expiration date, and a building needs to get built by a certain time frame. So you're seeing building from that regard. But you had 2 years of no building in New York because of uncertainty around the tax abatement here.
Sometimes the most creative deals done in the toughest of markets. Josh Zegen of Madison Realty Capital and Bloomberg's Abigail Doolittle. We thank you both so much for your time. Now, coming up, we're going to stick with private credit in our weekly Money Undercover segment, and we're going to talk about why the world's financial watchdogs are sounding the alarm on the growth of the business. This is Bloomberg. This is Bloomberg Markets, and I'm Sonali Basak. It's time now for Bloomberg Money Undercover. It's our weekly segment where we cover unique challenges and opportunities facing alternative investments. And this week at the Bloomberg Regulatory Forum here in New York City, the SEC, the ECB, and IMF regulators voiced concerns about private credit valuations. They warned about a lack of transparency as the market has ballooned to $1.7 trillion in size. Yet interest rates have remained high. For more on this, we are joined by Barings head of consumer ABS and CMBS, Yulia Alekseeva. You think about all these rising warnings among regulators, and part of this is because they don't really have oversight over the system. So when you think about what's being done outside of the regulatory purview, what is working and what is of concern?
Yeah, absolutely. I think the most concerning area, Sonali, is just the emergence of new asset types as it pertains to collateral. And when you say asset-backed finance, it means a lot of things to different people. Historically, it has been a very plain vanilla market, dominated primarily by credit like auto loans and credit card receivables. But over the last decade, it has definitely evolved to more esoteric types of lending. And now it includes things like solar, franchise receivable, data center, music royalties, aviation leasing, and more asset classes sort of that emerged over the last year. And I think there is some opaqueness pertaining to the valuation of some of those more esoteric assets, which is where credit investors need to really be diligent in understanding what they're lending against and how much volatility there can be in some of those new and evolving asset types that have not been tested through a market cycle, that have not been through an environment of ups and downs.
I think this kind of recalibration on what is risky and what is safe is a very important conversation. You think about auto loans. In the public markets, you have a lot of people concerned about that sector, yet it has traditionally been perceived as safe. When you think about both public and private right now, what are the riskier areas when you think about collateral?
Well, I think it's not so much about the collateral as it is about the convergence of public and private that are coming together. And so we are seeing those blurring lines. We are seeing the delineation between public and private becoming a little bit more blurry. And similarly, the delineation between fixed income and alternatives is also becoming a little bit more blurry. And really the biggest tailwind that's causing some of this evolution in the system, if you will, is the bank disintermediation that is caused by regulation. And what that means is you have this generational transfer of assets from bank balance sheet into non-bank entity balance sheets. And as a result of that, we have this new ecosystem with three types of key players emerging. One is banks. The second one is asset managers, and the third one is insurance capital, which is becoming an extremely important part of the puzzle.
You know, I had a conversation just a couple of weeks ago with Apollo's CEO, Mark Rowan. He's been a big advocate of this public and private market convergence, even trying to make an ETF tied to private credit. But if you think about all the different ways you're seeing the blurry lines show up, what's an example of that? What does that look like in your world?
Yeah, absolutely. And I think the way to think about it is the underlying collateral. And that is largely the same, whether you play in public markets or private markets, whether it's liquid or illiquid. Obviously, the format needs to be tailored to investor needs. And so we are yet to see this idea of a liquid ETF that's supported by liquid assets that I think is something that we need to watch out for. But as it pertains to asset-based finance, it's probably the fastest growing frontier within private credit that has been so far dominated primarily by direct lending. And as a result of the recent changes, I think everybody's looking to asset-based finance to really harness this growth opportunity. We at Barings feel very excited about it because we have the breadth and depth of capital and capabilities to really jump at it and capitalize on it. And it's really supported by three things. One, we have long history in credit. We have $430 billion in AUM. We have been playing in public and private credit for multiple decades. So really credit is the core of our DNA. And secondly, back to the insurance point that I made, we're owned by MassMutual Insurance. It's one of the largest and highest rated insurance capital companies in the world. And it is a mutual company, which I think is a very important aspect to make because it's not driven by short-termism.
We do have to leave it there. That is Barings Head of Consumer ABS and CMBS, Yulia Alekseeva. Of course, looking forward to covering this with you as the market keeps developing. And coming up, we're going to talk to Northern Data, backed by Tether, but it's planning to sell its crypto mining unit and pivot more to AI. We're also going to take a closer look at markets with you. Stick with us. This is Bloomberg. Welcome to Bloomberg Markets. I'm Sonali Basak. Let's get a check on these markets. The S&P 500, the trade has been fascinating today. If we spoke about 10 seconds ago, really, we would have been in the red. We are unchanged on the day. We'll keep an eye on that as we go along. The NASDAQ 100 still up about 0.5%, though. The 2-year is interesting. We're at 404 right now. You're feeling a bigger bid right now. In the 10-year, it's fascinating. We are now below that 420 level. That's about 5 basis points lower than we had been. So you are seeing some money move back into the bond market. We're going to also look at some midday movers on the equity side with Bloomberg's Abigail Doolittle. Abby.
We're seeing some weakness for the airlines. Earlier, American Airlines had been higher after a really big beat. They beat earnings by more than 100%. It is 30 cents, so it's not huge, but nonetheless a beat. They also beat their sales target, and they've boosted the outlook, but it seems as though the overall tone of the market's weighing a little bit. Plus, you have Southwest Airlines down more. They also put up a big quarter, but in the quarter to be, they talked about, or it's apparent that those high costs that American Airlines they're contending with, and it could affect their numbers in the next quarter. So that stock down about 4%. Turning to Lam Research, the semi-cap equipment company, so they make the equipment that makes chips, higher, up about 3.1%. They put up a better quarter than expected. They also boosted their second quarter sales view. So again, investors rewarding these shares, and this is an early tell in the chip sector, so maybe a positive sign there. And then finally, again to the downside, we do have Union Pacific trading lower by 5.4%. They did miss their estimates, despite 9% adjusted earnings growth. That wasn't quite enough because, again, it missed the mark for Wall Street analysts. And some Wall Street analysts are saying that they think that this stock could edge lower right now, down 5.3%. So that does seem to be the case. And on the year at this point, Sonali, down about 7%.
Abby, thank you so very much for your time. We are now going to check in here with Europe's largest cloud service provider, Northern Data. It's examining a possible sale of its crypto mining business to free up funds for expanding AI operations. Tether owned nearly half of the company as of February. Northern Data has also been weighing a U.S. listing of its combined AI cloud computing and data center businesses at a valuation of up to $16 billion. And for more, I'm joined by the company's COO and board member, Rosanne Kincaid-Smith. Let's talk first about some of the activity around Northern Data, the strategic decisions you're making here. Why is exiting crypto more of a move for you now, especially in the middle of this AI boom? Does it allow you to focus more?
First, thank you very much for having me. And yes, absolutely. We're very big believers in the impact that the blockchain technology can have on the financial landscape. But for us, focus is absolutely key, and we are very focused on expanding and developing our AI solutions business. And the divestment of our crypto mining arm allows us to do that. And as you mentioned, that actual investment will help us to expand our services and products and ensure that we're able to continue to build out our infrastructure in the most sustainable way possible.
What can you tell us at this juncture about a potential U.S. listing for your businesses?
We've been very open as a company that we're always constantly weighing up the opportunities that we have. That includes acquisitions, divestitures, or a change of listing. Ultimately, what we're looking to deliver is long-term sustainable value for our shareholders, and we'll choose the market for that in due course.
How long do you have to wait for some of these strategic decisions, given the macro environment that we're in, the uncertainty, and even many of the players around you changing course so quickly? Do you feel that it's better to wait until after the U.S. election into a more stable interest rate environment to make those kinds of moves?
I think in the current environment, now is definitely the time. There is no better time to make those decisions. In fact, in my personal opinion, instability drives opportunity that you will never see again. And what a time to be alive. With the US elections coming up, I think that will certainly change potential decisions on policy. But for us, expansion is key, and the opportunity for AI is absolutely now. And so we won't be waiting to make those decisions. We want to invest now to see the real life applications of AI.
Now, you have a very unique view about AI, the applications, and the largest players in the world. You are a partner to NVIDIA, one of just 11 sovereign AI clouds to partner with the latest Blackwell technology. What can you tell us about how that technology works?
Well, Blackwell technology is the embodiment of a true technological leap forward. It's almost 30 times more performant than the technology that we use in our data centers today. The possible part of that concerns people is that it's also incredibly power hungry. But where we come in on that stage is that our data centers are actually fitted out with direct-to-chip liquid cooling and specialized innovation to ensure that that heat production doesn't damage the environment, and that actually when that technology is used, you're getting the best out of it in the most secure way possible.
What can you tell us about kind of the challenges here in the power space? You have a lot of U.S. companies starting to even look to nuclear. And also, you would have a global view on this, perhaps looking to other parts of the world to have more capacity. How do you think about the changing landscape here and the biggest challenge for companies?
I actually think the move to nuclear will be one that is incredibly game-changing for the industry. But for Northern Data, we have definitely focused on renewable energy sources, and we continue to focus on expanding our capacity with hydroelectricity. As nuclear starts to expand, I definitely see the opportunity to power data centers and this new technology that will come post-Blackwell, and the expansion of the AI ecosystem to be powered by nuclear.
Rosanne, it is so nice to have you here. That is Northern Data Group COO Rosanne Kincaid-Smith. Obviously a lot going on in her space and at the company as well. As we get closer to the U.S. election, more and more attention is being paid to betting markets. Who is going to win the presidential race? But there's some concern that some of the results might be skewed, especially for Polymarket. We spoke to former FDIC Chair Yelena McWilliams, saying that the prediction markets are often incorrect.
Most of the predictions end up being flawed in some way. I think that the good news about the United States is that the markets do tend to adjust. The bad news is that the predictions that are in play right now could skew the market expectations over the next few weeks, because I do not think that the election outcome will be available to us on November 6th. So it may take more than a few weeks to come to the bottom as to where we end up with the regulatory issues.
And lo and behold, we have an update today from Polymarket. The company says that a trader who spent more than $45 million on bets that Donald Trump will win the upcoming election has been identified as a French national. Bloomberg's Emily Nicole has been following this story through and through for the last few weeks, joins us now from London. What do we know about the trader himself? And then also what this really means for what is happening on Polymarket?
So what we know about the trader at the moment is that they are French nationals. They're not a US person. People in the US are not allowed on Polymarket. And that was the main concern here, that they could be manipulating the markets for the election. And that they were the person behind 4 of the largest accounts on the platform, controlling around $45 million worth of holdings across many markets on Polymarket, but almost all of them favoring a Republican outcome on November 5th.
Well, what is the issue here in terms of skewing the perception? Because you have here in the United States, one reason that Polymarket is international is because regulators in the U.S. have been pretty critical around election betting. Is there any evidence, though, really, Emily, that this does skew perception or outcomes in any real way?
So if you ask Polymarket, they say that, the results on their platforms are mostly in line with what we see elsewhere. However, in practice, what we can see on the terminal using WSL Election Go, the various providers that we've got, Predict It, Kalshi, Polymarket. Polymarket always comes out a little bit further ahead in Trump's favor than everybody else. I think right now, Polymarket has him at about 61% or 61.5% likelihood of winning the election, whereas the others put him at about 59%, 57%. And so you can definitely see there's a real divergence for Polymarket's results. That said, it is a very different user base. Everybody who bets on Polymarket has to do so in cryptocurrency. It requires a level of different participation than you might get on something like Kalshi, which is allowed to provide US election betting now that it's had its case against the CFTC kind of resolved in the courts. But Predict It, is an entirely different model altogether. And that's why we kind of see some skewing when you look at different markets.
Emily, we thank you so much. And thank you very much for all of your reporting on this as well. And coming up, Ingram Micro has begun trading on the New York Stock Exchange. CEO Paul Bay joins us next to outline what's next for his company now that they have gone public. This is Bloomberg. This is Bloomberg Markets, and I'm Sonali Basak. It's time now for the stock of the hour, Ingram Micro, the hardware and software company returning to public markets today. It has started trading this hour, and it comes after raising more than $400 million in the IPO. And it was an IPO, remember, that was at the top end of the middle of the range, pretty much. It is backed by Tom Gores' PE platform, Platinum Equity, which will continue to control almost 90% of the shares. Platinum acquired Ingram's group from China's H&A Group in a $7.2 billion deal back in 2020. Joining us now, though, from the New York Stock Exchange is the CEO himself, Ingram Micro, Paul Bay. Talk about the experience, because I think one thing fascinating for folks, Paul, is that it has been a hard year to go public. The pipelines are just starting to open up. Companies in your space tend to command pretty significant valuations. You did indeed get a pop. You didn't raise at the top end of your range. What were some of the opportunities, challenges as you went through this process?
Yeah, well, we're really excited because we got a great list of investors while we are out having conversations. Our story's really resonating about what we've invested in. So we talk about how we've invested ahead of the curve, and really we're the future opportunity with us on a go-forward basis. So very good response to the markets as we went out and told our story.
Another part of your story that is pretty unique in this particular market is the private equity ownership. And so when you were talking to other investors to come in, how did that become part of the story? Was it more of a challenge, or was it something that, you know, they said, okay, well, wait a minute, they're sticking around for a little longer? So is it a partnership?
It's been a great partnership. Platinum Equity has been a great partner. We accelerated our investments around our AI-enabled digital experience platform we call Xvantage, and they were actually making sure that we were leaning in to accelerate that investment. So it's been a great partnership so far.
What do you think about AI spend right now? Because where we are in the cycle, of course, other AI-focused companies have commanded such stellar valuations. People are a little less afraid of the macro now, but it has been choppy out there for investors. When it comes to spending on AI and the amount of companies that are able to come to the table, clients, how do they feel about this moment? Do you think that there's a risk that things are just a little expensive out there?
I think it's a great opportunity for us because we sit right in the middle of more than a $3 trillion ecosystem from technology. And our average deployment has 6 products associated with it. And AI will be a critical part of that as we continue to move forward. So we're looking at how those pieces come together from an AI standpoint. So we both are using AI, as I mentioned, in our Xvantage platform, but we're also helping bring together all of our 1,500 vendors that we do business with and how AI is going to help enable an easier outcome for the millions of businesses they serve each and every day.
Well, what are some tangible realities of that as well? I think AI has been such a large buzzword, and if you look through your own prospectus, you're really plastered with a lot of your cloud services as well. Why is AI such an important turn?
Because it's really driving productivity. What we're able to do is now, as an example, we get over 3 million emails a year that are orders that come via email. We actually, through our patent pending technology, we have more than 24 patents pending on our Xvantage platform. We're actually using large language models along with machine learning, bringing that in, and again, that's wrapped all around AI, and they're touchless now. So no longer are we having to take in those emails and rekey those in. It's basically making it a touchless process. More importantly, it's actually given a better experience to our customer and ultimately out to those end businesses.
Now being public, what does your stock really bring you? Does it give you the potential for future M&A in the industry? Where is it really making the difference for the way your business is going to evolve moving forward?
We're taking our primary and we're actually paying down some additional debt. We'll obviously have follow-on offerings down the road. We actually have the ability, if we want to do significant M&A, we're already well capitalized and have the opportunity to liquidity if that's what we wanted. So we're in a good position and we'll continue to move forward and continue to deliver for our customers.
Really quickly, one more about the process. I'm so curious, Paul, indulge me. Is part of the IPO plan, were you trying to get ahead of the U.S. election before things got too choppy?
Well, if I go back to Ingram Micro, we're a $48 billion company that operates in 57 countries, and we have 161,000 customers. So we did take a short look at what was happening with the U.S. elections, but that never held us back and was a decision that we knew moving forward because we have such good diversity on a global basis. So really wasn't an issue for us as we were coming to the public markets.
I'm sure a lot of CEOs out there will appreciate business must go on. Paul Bay, congratulations.
Exactly.
CEO at Ingram Micro, of course, trading for the first day right now on the New York Stock Exchange. And coming up, Australia, struggling to reach an inflation rate of 2 to 3%. Treasurer Jim Chalmers joins us next from the IMF annual meeting to talk through his vision for a soft landing on the fiscal side. This is Bloomberg. This is Bloomberg Markets, and I'm Sonali Basak. The IMF recently warned that Australia may need to cut spending, even though it just had a second budget surplus in a row. We're going to discuss this with the man in the middle of this issue, Treasurer of Australia, Jim Chalmers. What do you make of the IMF's report? Let's start right there, because, of course, really the IMF's growth forecasts and recommendations, it's the shot heard around the world. How do you feel about your budget in relation to what they had said?
Well, first of all, Sonali, thanks for having me back on Bloomberg TV. It's a real pleasure. There's obviously a lot of insights in the IMF's reports that we find valuable, but the reality is in Australia, we've made really quite extraordinary progress in the fight against inflation. When we came to office a little over 2 years ago, inflation had a 6 in front of it, now it has a 3 in front of it. And next week we'll learn more about the situation as it relates to inflation in Australia. But we've made a lot of progress. That progress has been welcome. It has been encouraging. And a big part of our success has been the responsible way that we've gone about managing our budget. The 2 surpluses that we've just delivered are the first back-to-back surpluses for almost 2 decades in Australia. And they are a consequence, a welcome, deliberate consequence of the spending restraint that we have shown, the savings that we have found in the budget, so that we can rebuild our fiscal buffers as the IMF has been recommending all of us to do in the face of these uncertain global conditions.
Jim, I'm glad you also brought up the inflation story here because, of course, all eyes will be on that third quarter CPI report next week. And you were saying, yes, inflation has come down, but it hasn't come down as much as other countries. And do you accept that perhaps rates need to stay higher for longer in Australia in order to bring down that last mile of inflation?
Oh, well, first of all, there's an important convention in Australia that politicians don't make predictions or don't give free advice to our independent Reserve Bank. That's an important convention that I adhere to. But when it comes to the inflation story in Australia, again, we've made really quite outstanding progress in the fight against inflation. And any differences between our inflation rate and what we're seeing in some other countries are a consequence really of 2 things. First of all, inflation in Australia peaked lower and later than most countries that we compare ourselves with. That's a really important point. And secondly, some countries that have lower headline inflation than Australia have got much higher unemployment, or they've got weaker growth, or some other combination of undesirable aspects of the economy. And so what we've done in Australia is we've focused primarily on the fight against inflation, but we've done that without ignoring the risks to growth. We've struck a really effective balance between those primary economic objectives, and that's because we've taken the view that it is much better to avoid a hard landing in our economy than to clean up after one. We are on track for a soft landing in our economy. We're confident but not complacent about that. And the policy decisions that we've taken, whether it's the 2 budget surpluses, the way we've delivered our cost of living relief, the way that we're investing in productivity and dynamism in our economy, all of these things are really important ways that we're getting that inflation rate down without ignoring the risks to growth which are coming at us from an uncertain global environment and from some domestic sources as well.
Treasurer, to that end, do you think that the RBA needs to be moving faster? Do you think that they're being too cautious?
Well, again, I don't give free advice to our independent central bank. There's good reasons not to do that. I take responsibility for our part of the fight against inflation. Fiscal policy is playing a helpful role. The Governor of the Reserve Bank has said herself that our 2 surpluses are helping in the fight against inflation, and the way that we're managing our budget and our economy in the most responsible way that we can. Those are my responsibilities. I'll leave decisions about the trajectory of interest rates in Australia to the board of the Reserve Bank, which takes its decisions independently and appropriately.
We only have about a minute left here, but I do want to get your view here on your relationship with China. The removal of restrictions on lobster exports is imminent. And do you think that there's a new stage around the corner around the relationship between Australia and China?
Well, we recognise that the relationship with China is full of complexity and full of opportunity. We have our differences with China. We don't pretend that they aren't there. But our efforts to stabilise that key economic relationship have borne fruit, and including when it comes to the removal of some of those trade restrictions. And so we welcome the progress we've made in the lifting of those trade restrictions in some of our key exports. But we know that it's a complex relationship. We know that it needs ongoing management. And we believe that you get more out of engaging with our major trading partners than the alternative. And so far, that has proven to be the case.
Jim, we have to leave it there. That is Jim Chalmers, the Treasurer of Australia, of course, joining us on the sidelines of those IMF World Bank meetings. Now, we want to check on shares of Tesla, extending those gains up almost 20% on the day, giving a nice little boost here to the S&P 500, which is back in the green pretty firmly as well. We will keep you apprised of the markets as we go through the close today. Of course, it's been a choppy trade out there, but now back in the green. Now, I'm Sonali Basak. That does it for Bloomberg Markets today. Stick with us through Balance of Power. This is Bloomberg.